Welcome to the UTI Swatantra series powered by ETNow. Thank you for joining us. I'm Faye D'Souza. Today we're going to have a very basic discussion. Equity funds versus debt funds. When should you use the two of them, and how can you use them to build your wealth over the long term? In the studio with me are two wonderful gentlemen who are going to help us answer all of the questions that our audience has. Debraj Das is the founder at C.R.A.F.T Academia. And Abhishek Gupta is the CEO of Moat Wealth Advisors. Thank you so much for joining us. I will start with you, Debraj. Obviously, there is the view that mostly mutual funds are risky. Mostly mutual funds are, linked to markets, bringing in some sort of market risk. But there are also debt mutual funds, which a lot of our viewers are not aware of. Tell us what a debt mutual fund is and how it works.
Primarily, what debt actually means. Debt actually means a loan. Okay. So when you put a fixed deposit, when you park your money as a fixed deposit with a bank, that is a debt. Not from the investor's perspective, but from the bank's perspective, it is a debt. So when a debt fund is in question, so the debt fund invests in fixed deposits, in deposits of various companies, and hence that becomes more of a safer instrument than an equity market investment. So for example, if you invest say ₹1,00,000 in a fixed deposit of a bank, you get say an X rate, while when you invest through a mutual fund in that same fixed deposit, since the mutual fund actually accumulates so many investors with 1 lakh each or 5,000 rupees each, their corpus is larger. So instead of getting 9%, the mutual fund gets 9.25%, and hence you get a higher yield on your return. At the same time, you are investing in the same product, but in a more tax efficient way.
So there are two different things to consider with every investment. One is the rate of return.
Right.
The other one is the quantum of risk that I'm taking. How much risk am I taking in order to get this return? So if the return in case of a debt fund is marginally higher than a fixed deposit, is the risk also marginally higher than a fixed deposit?
Now, when we are talking about debt fund, so there are debt funds which have a mandate to invest only in bank fixed deposits, which are known as CDs, corporate deposits of banks. So if you go, so there are debt funds which only invest in bank CDs. So there won't, if there is a risk in investing in that bank CD portfolio of an MF debt fund, then there is a risk in investing in that fixed deposits of that bank directly also. So for an investor, this is a myth.
All right, so there are, we know that there are debt funds that invest specifically only in government securities. There are GSEC funds. Like you said, there are funds that invest specifically only in CDs. But there are other funds that trade these paper in the market. Is there a higher risk involved with those funds? Could you explain that risk to us?
So there are two types of risk investing in a debt fund. One is interest rate risk. The second is a default risk. So I buy a bond of certain company or a fixed deposit of certain bank, and the bank or the company defaults on payment of that particular bond. So one has to be very careful what type of bond fund. So if a GSEC fund, for example, there would be only and only one risk, which is an interest rate risk.
I'm asking you all of these questions because fundamentally a lot of distributors will go out and tell customers that, listen, a debt fund is exactly like a fixed deposit. There's absolutely no difference. And we learned a really hard lesson in 2010 when debt funds came down in value. So people who put money in debt funds actually lost money. And we'd never even assumed that something like that was even possible. But it is. So it is a risk that we should all be aware of.
Yes, of course. So see, investing always requires one to understand the investment before investing in that particular instrument. See, like what is happening today, the investor education, which is so very important, and hence all the regulators are so very harping on the fact that investors should be educated. That itself brings down the accountability of the advisor also. Okay, because now he knows that the investor is educated and he cannot be fooled. A debt fund, yes, it is a less riskier investment than an equity fund, okay, but it is exactly same as a fixed deposit. That is a wrong statement to make.
All right. Okay, so I want to bring Abhishek in here, and I'm very interestingly going to split them up into equity versus debt, because that's the debate we're having. We're all sort of familiar with the kind of risk and return assumptions that we get from an equity fund. Sure. In comparison to what we just talked about in a debt fund, tell us how to compare that to the equity fund. So if I've bought an equity fund on one hand and a debt fund on the other, what should be my assumption of risk and assumption of return that I will get from an equity fund?
Now, just to add to what Debraj said, now in debt, he said there are two risks, interest rate risk and a credit risk. Now, to cover that risk, to cover that interest rate and credit risk, there are two things. One is the quality of the portfolio in which you are investing, right? Second is the duration of the fund. So it's a liquid fund, which is 1 to 30 days, 60 days papers. Then there's a short-term debt fund, which is 1 to 3 years. Then there's an income fund, which is 8 years, 9 years, which is mostly a GSEC fund. So as the duration increases, the volatility increases. The interest rate risk increases. In an equity fund, it's very plain and simple. You invest in a fund, the fund invests in stocks. Yes. And the stocks are volatile. Market moves every day up and down. There can be large cap, mid cap, small cap. Small caps are more volatile because they go up also 10%, come down also 10%. So comparing debt and equity is not apple to apple comparison. You have to have an asset allocation. So depending on your short term, medium term and long term goals, you have to divide your money into different parts. So for a short term horizon where I need money for my daughter's education after 2 years, I don't want volatility in that. I want definitely that money after 2 years. I would not go a percent also in equity. I will put everything in debt. And if I have a horizon which is 7 year plus, I would definitely go all out in equity and get a return of at least 14 to 17%, which is the last 30-year return of the index.
All right, we're going to take a quick break. We come back, we'll answer questions that our audience might have about what was just explained on the show. Don't go anywhere. Welcome back. You're watching the UTI Swatantra series powered by ETNow. Thank you for staying with us. We're talking about equity versus debt funds, the difference between the two, and in what cases you should be using equity and in what cases you should be using debt. We have a couple of questions from our audience members. The gentleman in the front, go ahead.
How is it that you believe the equity fund per se is able to beget the returns that it is desiring to do? Because many a times what you invest on that equity fund is what will effectively give you that return, right? And there are a whole lot of assumptions and whole lot of presumptions in this whole picture. And many a times what you invest on is something which is a very judicious blend of investment as well for people who are actually playing in the mutual fund market. How do you decide that?
So firstly, we need to understand mutual fund is a vehicle. So you don't invest in mutual funds, you invest through mutual funds into 3 asset classes. One is gold, second is debt fixed income, and third is equity. So why can I say that it will give you a 13-15% return? Because if I'm investing in companies which are growing profits, earnings growing at 15 to 20%, the price has to match that. The price is a slave of earnings.
It is dependent on lot many factors, right? The equity fund return. To give you a perspective once again, 2008 January, okay, the markets, the BSE Sensex was at its earlier peak of 21,400 odd levels. From there it started correcting, okay. 2013 September, markets BSE Sensex came back to 21,400 odd levels. Effectively, if you see point to point return of BSE Sensex per se, the returns were hardly on a CAGR basis 1.63%. The worst of the large cap funds, okay, has given a return of 6.5% CAGR for these 5 years, the benchmark. But mutual funds large cap mutual funds investing in that particular benchmark, because of the professional management of a mutual fund through a fund manager, has generated a return which is 5 times more than the benchmark return. So hence, investing in an equity mutual fund does make sense, but with a longer horizon. Since the time Sensex, from 1978, since the time Sensex was born, okay, with 100 as the index value till now, the CAGR return has been 17.5%. Compound annual growth rate has been 17.5%. No other asset class has generated a return of 17.5% CAGR in Indian context.
All right. Do we have any other questions? Yes.
I have a question with regard to the valuation part of equity funds. Equity rather than equity funds. With more and more money chasing the market, I think 100,000 folios every month since Jan have been open. I'm not very sure about the exact number. More and more money is chasing individual stocks. How does a fund manager take a call that the stock is still reasonable and still has more value, considering the PE multiples have gone up, assuming people have put more and more money into that one stock?
It's actually a very interesting question. See, every bull phase, so there is a bull phase in a market where the markets are, really good, lot of enthusiasm in the economy, lot of enthusiasm in the market. In a bull phase, typical bull phase, you would always see the valuations running ahead of the fundamentals. Okay, and it will always happen. So there is an enthusiasm in the market. Okay, so if I say an X company is poised to do 20% growth on its profit this year, I will start investing in that company, and automatically the valuations, the multiple of that valuation will increase in terms of their fundamental, that is 20% of growth potential of that company. On the other hand, when there is a bear phase, okay, there is so much of pessimism that valuations will lag the actual stock price. So it is the fundamental which has to be taken into consideration. So that is the reason why professional money managers, like the fund managers of mutual funds, are to be trusted. Okay, so one is tip based investment, another is research based investment, that is which is the basic of any investing, irrespective of the fact whether you are investing in equities or you are investing in debt. So as he said, that even the portfolio of a debt fund, you have to understand what type of portfolio that fund is actually holding.
So any fund has an objective or mandate. So if it's a 100% equity fund or diversified equity fund, he will have to invest 100% equity irrespective of where the market is. He cannot say valuations are high, but he can change the sector allocation. If he thinks one sector is overvalued, he can reduce that. He can increase something which is going to do well in the next 2-3 years. So that a fund manager does with a research team dedicated for him, and they are day in and day out looking at stocks and companies and comparing valuations.
With regard to debt funds, it is an assumption of myself that a market needs to be really mature for the debt market to trade securities more openly rather than equity market. Do you think the Indian market is mature enough to start dealing with commercial paper and debt paper more openly, as in coming it down to the retail level rather than just at the fund level?
Maturity of a debt market per se. Again, you have to look at it in perspective. Equities, for example, has to be for a longer horizon, okay, 7 years, 10 years. Debt funds are more short-term in nature. Okay, so one can actually trade in debt with more affirmation rather than in equity, because debt gives signals. Okay, so suddenly, so it is based on your assumption of the fundamental of the economy versus my assumption. When it comes to trading in debt, howsoever mature the debt market becomes in India or anywhere in the world, it would be institution led. It will never be retail investor led.
So to add to that, if you see the most liquid debt securities are government securities, which have the maximum liquidity. You can sell anytime, buy anytime. And there are corporate bonds which are illiquid. So what fund managers do is, if they are buying a corporate bond portfolio which is not so liquid, they put an exit load. So they don't want you to get out because they will not have that money proceeds to sell the bond and give you money. So let's say there will be a 1 year exit load, 2 year exit load, 3 year exit load. Today there's a 4 year exit load also on a corporate bond fund. So depending on the fund and the portfolio, the fund manager has that liberty to put an exit load to stop investors from redeeming money at an early stage. So for a retail investor, if you want to come in debt funds, you keep the duration as low as possible so that the volatility will be the lowest. The lower the duration, the lower the volatility. So a liquid fund which has 90-day maturity, ultra short-term funds we call it. So there are also government T-bills and they're investing in shorter-term CDs, bank CDs. So they're absolutely liquid. There is no exit load. You can remove money anytime, put money anytime. And there are corporate bonds, portfolios for 1.5 year, 2 year, and 3 year and above you get a long-term capital gain benefit in taxes also and an indexation benefit. So for that kind of horizon, a corporate bond fund is a suitable fund.
All right, a disclaimer from my end, if you're unable to understand any of that, it's okay to invest in a fixed deposit. On that note, we're going to take another very quick break. When we come back, we'll answer more questions from the audience. Don't go anywhere. Welcome back. You're watching the UTI Swatantra series powered by ETNow. Thank you for staying with us. We're talking about equity funds versus debt funds and when you should use the two of them. I do believe we have more questions from our audience members. Go ahead.
Just like how we have a valuation methodology for equities, if we have to invest directly in equities like price to earnings or price to book value, or for that matter, other return on equity. Similarly, what is the way in which you can identify a good fund, mutual fund? Say it could be an equity or a debt fund. So what are those parameters?
So I'm going to turn this question around to make it relevant to the people watching at home and to the ones in the studio. I have 5,000 rupees to invest every month. At the end of the month, after everything else that I have spent on, this is money that ideally I would like to put aside for the next 10 years, which is the average question we get from all viewers. Where should I invest 5,000 rupees a month for the next 10 years? You all can both take a shot at it.
Okay.
Okay.
Selecting an equity fund would be the best option to go ahead. Okay, for a horizon of as high as 10 years, investing in an equity fund, in a good equity fund, would be a very good option. Now, selecting that equity fund, please, this is my personal opinion, please do not go by only CAGR, that is compounded annual growth rate. CAGRs at times are very misleading. Go by the persistency of that particular scheme. Whether year on year basis, it has been consistently returning, okay, on a top quartile or on a, if there are 100 funds, whether it is in the top 25 funds consistently. So look at year on year return also without only looking at the CAGR returns.
What about charges? We know that there is an upper cap, 2.5% that all equity mutual funds, maximum that they can charge you. But there are some that charge far lower than that. So if I pick a fund that charges lower, does that translate to higher returns over the long term?
It does, but sometimes doing that also doesn't yield the same return, because sometimes the fund which is charging a higher expense may do well better than the fund which is charging a lower expense.
Because a lot of times it's marketing expense.
Actually, that's all depends on the fund manager style and the return on the fund. So it's not a direct correlation that if the fund manager expense is lower, I'll make higher returns.
No, but if since the expenses come out of my investment anyways,
Yeah.
if it's not coming out of my investment, then net I should make higher returns, right?
So if you're comparing to a direct plan or to a regular plan, direct plan there is no marketing expense, nothing. So obviously you'll make much higher returns because direct plans will have a much lower expense ratio than a regular plan.
Okay. One more question. There are very, very large funds in our market right now. 4,000 crore rupees assets under management.
15,000 crores.
15,000 crore rupees assets under management. And there are small funds, 200 crore rupees assets under management. From a fund manager's point of view, if I'm putting my money in, should I go with the really large ones? Or should I go with the smaller ones thinking that, okay, he'll be able to, be able to be more nimble-footed in the market, he'll be able to move it around faster? What would make more sense?
So depends. So if it is a large cap fund, a 15,000 crore fund makes sense.
If it's a large cap fund.
It's a large cap fund. So probably the 15,000 crore fund today is not performing to the expectation, which is...
I mean, there's a general theory that when a fund becomes too big, it starts to slow down in terms of performance.
so there is no...
It's just too big to manage.
So there is no such theory attached to it. Okay. As I said, a large cap fund, okay, with a 15,000 crore of assets under management, 1% of that 15,000 crore would be 150 crores. Okay. 150 crores worth of investment in a large cap stock will actually not move the stock too much in the market. But that same 15,000 crore, if it is a small cap fund, a 1%, that is 150 crores in a small cap stock will actually, make the market.
So if I'm investing in a multi-cap or a small cap fund, then should I pick a smaller fund?
A medium-sized fund would be a better fund to be managed because see what
is medium size? 500 crore.
For a small cap and a mid cap fund, it would be anywhere between 1,000 crores to 2,000 crore, 3,000 crore is a good size because what happens is the fund manager will because small cap and mid cap funds stocks, they are pretty illiquid in nature. So if he has to even move 1% of that 15,000 crore funds, there has to be buyers to buy those shares that he is selling. So being a small cap stock, it is pretty liquid. So it is better to have a smaller AUM for a smaller mid cap type of fund and a larger AUM for a... So although there is no correlation on performance with respect to the AUM.
There are a lot of smaller funds which have outperformed the bigger funds. There are a lot of bigger funds outperforming the smaller funds. So there is no correlation as such. But obviously there is a restriction on the stocks you can buy if the fund goes beyond 12,000 crore, 10,000 crores. Because the universe of stocks is limited. It restricts more because you cannot put 150 crores in a stock, in a lot of stocks.
All right, another very, very quick question before we wrap up. We're running out of time on this show. How do I pick a fund house? I mean, there are various names available in the market. We're all familiar with these names. We bank with some of them, some of them have our fixed deposits, some of them have our bank accounts. So how do we choose, picking the actual fund? So, there are various stages of this decision, right? Do I want large cap, mid cap? Okay, we made that decision. Do I want a big fund or a small fund? We made that decision. Now, given the array of choices in the market, how do I decide, okay, this is the fund house that I like, I trust, this is the one I will do business with?
See, frankly speaking, it's very difficult for a retail investor to enter in that question because it's very confusing. Because there
Yet somehow we are forced to answer that question on a daily basis.
So it's 44 fund houses,
Yes.
each having multiple equity funds, multiple debt funds. There is a gold fund, there is a arbitrage fund. There are a lot of jargons floating around. So that is where you need a advisor to help you select a good fund house because he's seen it since a long time. He knows what's a track record. There are smaller fund houses which have done very well in the last 1.5 years, which the larger ones have not. So for a retail investor, if you open a website and you just sort by return and select the best return fund, then the next year can be very bad. You don't know. It can be better also, but the chances of making a mistake are very, very high. So I would recommend you go with an advisor who understands your needs, your goals, and then advises you a fund house or a fund, depending on your requirement.
Unfortunately, we've run out of time on this show, but I mean, the logical question to that answer is how do I choose an advisor? But that's a half-hour show by itself. So you're going to have to come back again next week. Gentlemen, thank you so much for joining us on the show. You've been a wonderful audience. Thank you for joining us. Remember, if you would like to write to us or you'd like to join us in the studio, log on to our website, beswatantra.com, or send us a question, #Swatantra. Thank you for tuning in.
Brought to you by UTI Mutual Fund. हक एक बेहतर जिंदगी का.
Mutual fund investments are subject to market risks. Read all the scheme-related documents carefully.